Every person on the planet probably wishes they could invest like Warren Buffett. There's an abundance of authors and investment professionals who track his style relentlessly, but they don't seem to get it right. In today's video, you might not be investing exactly like Warren Buffett near the end, but we will take you a few steps closer with these 3 simple and easy steps. So number 1 is to understand the business. What does this mean exactly? Well, too often I see myself, when people investing in stocks, they invest in a company without full-blown knowledge of what this company exactly does. One strategy that has made Warren Buffett so successful is his willingness to invest in businesses that are really simple in their model and the way they make money. So when we say understand the business, what we're trying to say exactly is you should be able to explain this business to a 10-year-old. And the only way you can explain it to a 10-year-old is to really simplify it. And the only way you can really simplify it is if you really understand it. So when you talk about a business, you should know what kind of products they sell, what the growth trajectory is for these products, and the market for these products. Assuming the business is diversified, you should also be able to explain which segments of its business do the best. You should be able to talk about some geographic factors, and you should be able to provide some basic information on its balance sheet in regards to how much debt it has and how much money it makes, so simple valuation metrics. Now you'd be surprised, a lot of people invest in companies that don't have this basic information down. There seems to be some misconception in the investing public that if a company is complicated in their business model, that must suggest that they will be successful. I often see the beginner or novice investor going after some very complex biotech company or some company that's investing in some revolutionary technology. And though there is the off chance that this company can be immensely successful, for the most part, if you don't understand the business of this company who's trying to make some revolutionary technology or medicine, you probably shouldn't invest in it because you won't have the upper edge relative to the market and the market participants. And oftentimes the simple business actually outperforms. For example, Domino's and Google both IPO'd in 2004. And here's the performance of their stocks since 2004 accumulated. Domino's has outperformed Google quite substantially. Now this is pretty odd if you think about it. After all, Google provides some revolutionary technology that everybody around the globe uses almost every day. Whereas Domino's is just a pizza joint. Well, again, this serves the point that oftentimes the simple business with a simple business model can beat these super complex high-tech stocks. Number 2, understand the management. Now it doesn't matter how great a business is if the managers that run it don't do a good job. Warren Buffett takes a lot of time to get to know the management of a company when he's looking to buy their stock. Before you invest in the company, you should look into the philosophy of the CEO and other management executives. It would also be quite prudent to look at their track record. For example, as you may know from my previous videos, I am very bullish on Chipotle. One of the reasons for that is because of their new CEO, Brian Niccol. He likes to include digital and mobile integration into his business, and he doesn't fear change and a shake-up in the firm's business model. For example, he wants to introduce breakfast and a drive-thru in Chipotle. Jeff Bezos' philosophy to have the most customer-centric business in the world. He believes it's okay to suffer in the short term to introduce a long-term successful business model, and he likes to invest in superior products at discount prices. So these are just some examples of management policies that I resonate with, but more importantly, it's me as an investor understanding the management that I invest in. And number 3 is to think long term. And by long term, I mean long term. One of Buffett's famous quotes is, "The best time to sell a stock is never." Too often people become engaged with the short-term market fluctuations and aren't able to see the bigger picture. There's a boatload of financial and economic data that suggests the longer you hold a security or your investments, the increase in the likelihood that there'll be a payoff financially. One way Warren Buffett likes to talk about how he analyzes his business is he says, imagine if you invested in a stock and the stock market was closed off for you for 3 to 5 years. How will this company fare in 3 to 5 years? What will be the value of this company 3 to 5 years down the road? That's the way you should analyze your businesses. You shouldn't be looking at a company in the 1 month or 3 month time frame. Look at a company, see its business model, look at its market and the goods and services it provides. By looking at some basic characteristics of a company, you should be able to come to a conclusion as where a company will be 3 to 5 years down the road. And if your conclusion is that they will be more valuable 3 to 5 years down the road, you may have found yourself an opportunity. So for example, I don't know what's going to happen with Facebook in the next month. I don't know what's going to happen with Facebook in the next 3 to 6 months. But Facebook in its business model and in the service that it provides, I can say with almost a great deal of guarantee that Facebook 5 years down the road will probably be more valuable than what Facebook is today. So to summarize very briefly, understand the business, look into management, and think long term. With these 3 simple steps, you are well equipped to skew your investment results in the better direction. I want to thank you guys for listening. Don't forget to like, comment, and subscribe, and we hope you have a nice day. Take care.